It's Chris Bowling.
Chris Beyer.
Happy Friday, CB.
Same to you, sir.
We have a special guest, Dale. Dale, thank you for joining us. Dale's with QB&E, a wonderful reinsurance carrier, and we've been talking a lot about captives. And we're like,
Yeah.
Dale, we think you would be a way better suited person to interview than Chris and I trying to talk about captives. So, thank you for joining us today.
I'm glad to be here, Chris. Thank you.
So,
Yeah, Dale, if you would give us a little bit of your background and a little bit about what you're doing with QB&E.
Yeah, so my background, I've been in the employee benefits arena for about 15 years at this point. Third-party administrator, consulting firm, stop-loss carrier. And through those 15 years, I've gravitated more and more towards captive insurance. I've been working with captive insurance for probably about 12 years. Started off really being an analyst for a large captive program, a group program, where they were seeing amazing success, where they were banding together a group of like-minded industry folks and doing what they could to drive down the cost of healthcare. And it was a beautiful thing to me. And, through the years, I fell more in love with it. And I had an opportunity to jump right into the captive space and learn more and more about this wonderful area that most employee benefit advisors really don't know how to utilize.
Yeah.
So I've been running with this for a while. I'm excited to continue.
what do you
Excellent.
think? What do you think QB&E is doing that's creative, unique within that captive space that's really got us to start talking to you as well?
Yeah, so QBE, global insurer, we've been supporting captives for almost 20 years. And ultimately, we have 27 captive programs today that are running well. And it's an area in which we see a lot of growth. We have a lot of questions from our clients that ultimately say, how do we do this better? How do we do this more efficiently? And we support just a variety of captive programs, which makes it really exciting for me because, if you've seen one captive, you see one captive, right?
Yeah, that's very true.
Single parent captive, group captive, fronted captive, assumed deal captives where they're direct writing their own policies. And there's some captive programs where, it's the carrier isn't even taking the risk. It's just they're supporting you from an underwriting, clinical, actuarial perspective, and you're just running with your own policies in your own captive. Now that's more, captive 501, but, QBE and I, it's a great opportunity for us to dig our heels in and really enhance the market.
Why do you
I think it's been, go ahead, Chris. Sorry, go ahead.
Why do you think the risk is better? You say that, our captives are running well. Can you give us one or two quick points as to why you think that is? I mean, why is that different than, a big BUCA self-funded plan, that's not in a reinsurance captive?
Yeah, it's a great question. So I'll take this from a couple different angles, if you don't mind.
Sure.
The first one is moral hazards removed from the equation, right? Typically, when you're buying stop loss, it's just a black and white transaction. You're just trying to pass on risk that you're uncomfortable with to a stop loss carrier. And it's very inefficient, right? Well, when you have a captive that you're plugging in place, you're taking a higher level of catastrophic risk. So you're going to care more about those high cost claimants, the cancer claimants, the ESRDs, the high cost drugs. These are all things that we talk about a lot, but unless you're actually taking that risk on or sharing it with other like-minded employers, it sometimes becomes the last thing you want to worry about. So with captives, we see the risk management moving to the front of the conversation and ultimately providing some great results. So I would say that's probably first and foremost. But what I'll also share with you is that this is also an opportunity for advisors to really start to branch out and find a way to enhance your brand.
Yes.
Right. Yes. So you're driving a lot of resources into a captive space, and sometimes where now you actually can manage a program that is essentially going to drive lower costs. So now instead of this client with their plans, this client with their strategies, and it's kind of bifurcated. If you could bring them all together in one unique ecosystem, now it's making it more efficient for you. You're plugging in solutions that are impacting costs, and ultimately that's helping the bottom line.
So, well, Chris, I think as we've looked at that too. I mean, you and I have spent a lot of time talking about how we're helping our clients with pharmacy, with large claims, getting a better way to purchase healthcare services for their employees. But if they're in the traditional stop loss world, they may not be receiving the credit for that extra activity. It's, to your point, Dale, it's just the transaction where, as we're seeing the captive space help, when we are taking those steps to reduce costs, we're getting a reward back to the employer for actually doing that beyond just claims costs. It's truly helping their reinsurance costs. So that fits in well.
So I'm going to add
Absolutely.
something to your first point, because I have a client, we have clients in captives, and one client had a very bad year, and we were going to the captive meeting. He was nervous. He's like, what are my peers going to think about what happened to, my claims? I mean, you don't have that mentality if I'm buying an XYZ stop loss carrier and all I want is reimbursements back, right? I want them quick. When you're in a captive and you're sharing risks, I mean, this guy sat way in the back of the room, and I was like, it's okay. Everyone has a bad year, but I mean, he literally was apologetic about they had a very bad claim, and it's funny. Everyone was like, could it have been avoided? No, and they're like, that's why we buy insurance, and that's why we buy reinsurance. But I'll say that's the part, Dale, that I have seen more than anything. It is the accountability that you have in the members of that captive, that, hey, I'm trying to do everything I can to make sure that I'm not the one that, implodes that captive that year.
Yeah. Just real quick, I'll expand on that. So there are some captive programs where it's just a blind transaction. You're just a part of a pool. You don't meet those individuals. You're not going to learn anything from the other advisors. It's just a captive. And then there are actively managed captive programs in which they want to bring up that competition, right? They want you to feel that pressure, right? So it makes it really fun.
As you've mentioned too, I mean, so many different ways to install a captive. One captive is one captive, as you mentioned. There's so many, I think, stair steps too, especially if you see employers now, as we're talking with so many, we want to try to self-fund. We want to try to get out of that fully insured space, start to get some control, that this can be an easier entry point to them than just going to the general reinsurance market and hoping that somebody is receptive to them. And I think that's an area that I know you have talked with us about, is just how do we make that transition from this strategy to the more advanced strategy and make sure that it's structured correctly.
Yeah, absolutely. And from an underwriter's perspective, if they know that you're going to be taking a little bit more risk in terms of posting capital or collateral, the underwriter's feeling a little bit more comfortable with you if you have some data that's hard to wrap your head around. So yeah, it's an absolute perfect opportunity to open up a market.
Oh, that's wonderful.
Well, I know this was quick. Unfortunately, we only get 10 minutes. But then, we could probably do 3 more sessions on this and really dig into your brilliant mind around, what else can we do? And we will absolutely have you back on this in the future. But I think it was a great introduction, to captives. If there's one last thing that you would say to any employer out there watching this that's, struggling with exactly what Chris said, oh, there's too much risk for me to go from fully insured to a captive, what would you tell that employer?
Yeah, I'll take it from a perspective of the many fully insured versus self-funded analysis that I've seen, right? So there's some times where you run this analysis and you say, I want to go self-funded. This sounds great. And then you go to the market and there's just no stop loss for you, right?
Yeah.
At that point, yeah, sometimes it makes sense to flip the switch and say, okay, I would like to post a little bit more collateral or capital to have a quality stop loss contract to self-fund for the first time. So, I think the stat from Kaiser Foundation is that only 21% of small employers under 200 are self-funded today.
Right.
So that's an area that you're going to see a lot of growth because captives are now opening up that market.
Yeah, that's well said. I think just the commitment that I'm willing to put up a little bit more than just pay a premium. And I think that shows the seriousness and the intent to really commit to self-funding. And that's awesome to hear that that's a vehicle to use. Well, Dale, we appreciate you being on this morning. Thanks for taking a little bit of time to explain your background with captives and a little bit for our employer groups.
Thank you, gentlemen.
Thank you,
Awesome.
Dale.
Good to see you.
Good to see you.